Welcome back to Finance Buzz Friday. We always bring you the most pressing issues in finance. Well, today we're diving deep into some cutting-edge AI security risks. These things are really keeping the financial world on high alert right now. And, it's model inversion and membership inference. Two things that could seriously shake up the industry, especially, for UK financial institutions.
Yeah, you're absolutely right. I mean, these threats are not just theoretical. Like this represents a real paradigm shift in how we're thinking about data security and AI in finance.
So, for those of us who haven't, had a chance to really dig through all this latest AI security research, can you break down these threats, in a way that kind of makes sense for the finance world?
Absolutely. Let's start with model inversion. So imagine you have a sophisticated AI system. It, approves loans, and this system is trained on a massive data set, customer financial data. Now, a hacker using model inversion techniques could essentially reverse engineer that AI, not to steal the data itself, but to understand the patterns and criteria the AI uses to make decisions. So it's like figuring out the secret recipe,
Yeah.
Behind a company's success, except in this case, the recipe is for making loan approval decisions.
So instead of just directly hacking into a database, they're hacking into the AI's brain, essentially.
Exactly. Now think about this in the context of the UK's financial sector,
Yeah.
which is heavily reliant on AI for things like, fraud detection, algorithmic trading, risk assessment. If a competitor could use model inversion to reconstruct a bank's proprietary trading algorithm, it could give them a significant edge in the market, potentially destabilizing things.
That's a pretty unsettling thought. And what about membership inference? How does that play into this?
Yeah, so membership inference is all about determining whether a specific piece of data was used to train an AI model. Think of a hedge fund that's, developed this highly successful AI for predicting stock prices. If someone could use membership inference to figure out which specific data points were used to train that AI, they could potentially gain valuable insights into the fund's trading strategy, undermining their competitive advantage.
So it's not just about protecting the raw data itself, but also the insights and patterns derived from that data by the AI?
Precisely. And this becomes even more crucial in the UK, which has strict data protection laws like GDPR. Imagine a scenario where someone uses membership inference to figure out if a particular individual's data was used to train an AI system used by an insurance company to set premiums, and if that individual belongs to a protected group, and the AI inadvertently used that information to make discriminatory decisions, it could result in serious legal consequences for the company.
That's a great point. The UK's financial landscape, it's particularly vulnerable just because of this whole convergence of advanced AI adoption. And then you've got the stringent data privacy regulations.
It feels like UK financial institutions are kind of caught between a rock and a hard place. They need to innovate with AI to stay competitive, but they also need to be incredibly cautious,
Yeah.
About how they develop and deploy these systems. Yeah, it's definitely a balancing act. But there are, practical steps they can take to mitigate these risks. One crucial aspect is ensuring responsible AI development, from the very beginning. That includes being incredibly selective about the data used to train these AIs. Think about financial institutions using alternative data sources like social media activity to assess creditworthiness. I mean, if that data is biased or used improperly, it could lead to unfair lending practices, potentially even violating the Equality Act here in the UK.
So it's not just about, data security, but also data ethics and fairness, especially when AI systems are making decisions that directly impact people's financial lives.
Exactly. And there's another layer to this, intellectual property. Imagine a firm has spent years developing a complex AI model to analyze market trends. Model inversion could allow competitors to essentially reverse engineer that model, stealing their intellectual property without directly accessing any sensitive data.
So a company could lose its competitive edge without even realizing its data has been compromised.
That's the insidious nature of these threats. And it's not just about large institutions. Smaller fintech startups in the UK are also at risk. They might be relying on third-party AI providers for key functionalities. And if those providers aren't adequately protecting their models, the startups could be left vulnerable.
That raises the question of vendor due diligence. How can financial institutions, both large and small, ensure they're not inadvertently exposing themselves to risk by working with the wrong AI providers?
It's crucial to ask tough questions. What measures are they taking to prevent model inversion and membership inference attacks? Do they have, robust security protocols and data handling procedures in place? Are they transparent about their data sources and how they mitigate biases in their models.
So it's about looking beyond just the functionality and cost of an AI solution and really digging into the vendor's security and ethical practices.
Absolutely. And it's not just a one-time check. Financial institutions need to establish ongoing monitoring and auditing processes to ensure their AI systems remain secure and compliant with evolving regulations, like GDPR.
It sounds like staying ahead of the curve on AI security is going to require constant vigilance and adaptation. But surely there's a silver lining here. Like, these threats also present opportunities for innovation in cybersecurity and AI development, right?
You're spot on. We're seeing the rise of, cutting-edge technologies like differential privacy and homomorphic encryption, which allow AIs to be trained and operate on data without ever actually exposing the raw data itself. This could be a game changer for protecting sensitive financial information while still harnessing the power of AI.
So it's about building security and privacy directly into the foundations of these AI systems.
Yeah.
That feels like a much more proactive and robust approach than just trying to patch vulnerabilities after the fact.
Exactly. And the UK, with its strong research and innovation ecosystem, is well positioned to be a leader in this space.
This has been incredibly insightful. But before we wrap up, I want to touch on one more thing. While we've been talking about the threats to institutions, what about individuals? How can everyday people protect their own financial data in this increasingly AI-driven world?
That's a crucial point. Awareness is key. Start by understanding how your data is being used by financial institutions and what potential risks are out there. Ask questions about the security measures they have in place and challenge them to be more transparent about their AI practices. Remember, in the UK, you have rights under GDPR to access and control your personal data.
So it's about being an informed and empowered consumer, not just blindly trusting that institutions have it all figured out.
Precisely. And don't underestimate the power of collective action. Support organizations that are advocating for responsible AI development and data privacy. The more we demand better practices from financial institutions, the more they'll be incentivized to prioritize security and ethics.
It's about making our voices heard, both as individuals and as a community, to ensure that the future of finance is one that benefits everyone, not just a select few.
Well said. That's the key takeaway here. This isn't just about technology. It's about ensuring that AI in finance is developed and used in a way that's ethical, transparent, and ultimately serves the best interests of society.
That's a really powerful message, and it's a timely reminder that as AI transforms the financial landscape, we need to be actively shaping its trajectory, not just, passively observing its impact. But let's shift gears for a moment. We've been talking about the potential for these AI attacks to expose sensitive data, manipulate markets, even perpetuate biases. But what about the psychological impact on consumers? Could the mere awareness of these threats erode trust in AI-powered financial systems, leading to a chilling effect on innovation?
That's a fascinating question. You're right. It touches on the very core of how we perceive and interact with technology, especially when it comes to something as personal and sensitive as our finances. If people start to feel like their financial data isn't safe, or that the systems making decisions about their loans, investments, or insurance are vulnerable to manipulation, it could have a ripple effect far beyond data breaches and financial losses. It could undermine confidence in the entire financial system.
Yeah, like imagine a scenario where people become so wary of AI-driven financial tools that they revert to traditional, less efficient methods. Even if those methods offer less favorable terms or outcomes, that would be a significant setback for financial inclusion and innovation, especially in a market like the UK, which is striving to be a global fintech leader.
Exactly. And this potential loss of trust isn't just hypothetical. We've already seen examples in other sectors where data breaches and privacy scandals have eroded public confidence in technology companies. The financial industry is built on trust. Trust in institutions, trust in systems, trust in the very concept of money itself. If that trust is shaken, the consequences could be far-reaching.
So it's not just about building technically secure AI systems, but it's about building trustworthy systems. Systems that people feel comfortable using, knowing that their data is protected, their privacy is respected, and their financial well-being is genuinely prioritized.
Absolutely. Financial institutions need to go beyond just ticking the boxes on compliance checklists. They need to actively demonstrate a commitment to transparency, accountability, and ethical AI development. That means being open about how they're using AI, explaining the decision-making processes behind these systems, and providing clear avenues for recourse if something goes wrong.
And perhaps even more importantly, it's about actively engaging with the public, addressing their concerns, and fostering a dialogue that builds trust rather than breed suspicion.
I couldn't agree more. The future of AI in finance hinges not just on technological advancements, but also on our ability to build and maintain public trust in these systems. It's a challenge that requires collaboration between policymakers, regulators, financial institutions, and consumers themselves.
It's a call to action for all of us to be informed, engaged, and proactive in shaping the future of AI in a way that's responsible, equitable, and ultimately benefits society as a whole. And on that note, I think it's time to wrap up our deep dives into the world of AI security risks in finance. We've covered a lot of ground today, from the technical intricacies of model inversion and membership inference to their potential impact on the UK financial landscape and the crucial role of trust in navigating this new frontier.
It's been a fascinating discussion, and I hope our listeners come away with a deeper understanding of these emerging challenges and a renewed sense of agency in shaping the future of AI in a way that's beneficial for everyone.
Well said. Thank you for joining us on Finance Buzz Friday. Until next time, stay curious, stay informed, and most importantly, stay engaged.